There's a factory at the edge of a small town. Nothing glamorous. Metal parts, industrial components, 40 employees. The kind of place you only notice when it's gone. The owner started it 30 years ago in a rented garage. Worked weekends, skipped vacations, reinvested every profit. Built something that outlasted him. Now he's retiring. His daughter wants to take over. She knows the workers. She knows the machines. She grew up walking those halls. And then a letter arrives. Text you. Immediately. 7 figures. In cash. Not in buildings. Not in machines. Not in commitment. Cash. The company is profitable, but not liquid. So the choice is simple. Sell part of it, take on debt, or sell it entirely. By the end of the year, it belongs to an investment fund in another city. The logo stays. Half the staff doesn't. Politically, nothing happened. Economically, everything did. Welcome to The Price of Policy. I'm Matthias Rieger. This is a podcast about politics and economics, and about the costs that quietly accumulate once policies turn into slogans. Politics loves promises. Economics keeps the receipts. Tonight, inheritance, not as a moral symbol, but as an economic mechanism. There are few words in politics that trigger faster emotional reactions than inheritance. You don't even need an argument. Just say the word. Inheritance. And the verdict appears instantly. Unfair. Unequal. Unearned. Feudal. It's often treated like the last remaining sin of capitalism. Wealth without merit. Privilege without effort. So taxing it heavily feels riches. Almost cleansing, like conducting history. But policies that feel morally satisfying often hide their costs best. Because inheritance isn't just symbolism. It's infrastructure. And if you attack infrastructure emotionally, you damage it economically. Let's strip away the drama. Inheritance isn't money falling from the sky. It's capital that has already been taxed, invested, risked, sometimes nearly lost. In reality, it usually looks like family-owned firms, workshops, apartment buildings, machines, long-term contracts, boring assets, productive assets, the kind that quietly employ people. So when politicians say tax inheritance, what they often mean, whether they realize it or not, is taxing continuity. The ability of capital to remain productive across generations. Listen, inheritance tax doesn't punish the dead. It disciplines the living. Here's where the debate quietly becomes misleading. It assumes wealth equals cash, but most wealth is liquid. A business might be worth 10 million euros on paper and have almost no cash available because the value sits inside machines, buildings, inventory, employees. In many small and medium-sized firms, liquid reserves represent less than 10% of total firm value. You can't pay the tax with forklifts. You can't wire them half a warehouse. But taxes demand liquidity immediately. And if liquidity isn't there are only three options: sell assets, take on debt, or break up the company. None of these improve productivity. All of them weaken resilience, which means the tax doesn't just transfer wealth. It damages the productive structure itself. Forced sales are not neutral events. They don't simply transfer ownership from one person to another. They change the structure of markets. Because forced sales create a very specific kind of transactions. A seller who must sell and a buyer who knows it. In economics, that asymmetry matters. When a sale is voluntary, the owner can wait. They can negotiate. They can reject offers. They can choose the buyer that fits the long-term future of the company. But when liquidity is required immediately, time disappears. The seller cannot wait for the right partner. They must accept the available one. And in those moments, markets behave predictable. The player with liquidity wins. Who are those players? Large corporations, private equity funds, institutional investors, actors who specialize in acquiring companies quickly. They have teams for this, lawyers, financing structures, acquisition departments. They can move within weeks, sometimes within days. Family successors cannot. They are trying to keep the company alive. External buyers are trying to price the company correctly. And when time pressure enters the equation, the price changes. Because urgency always weakens the seller. And when time pressure enters the equation, the price changes. Because urgency always weakens the seller. Economists call this a distressed transaction. Assets sold under pressure rarely capture their full economic value. The buyer knows the seller has limited alternatives. So negotiations shift, not towards the long-term potential of the business, but towards the immediate constraints of the owner. And this is where policy unintentionally shapes ownership structures. A tax meant to redistribute wealth can end up redistributing ownership away from local entrepreneurs toward centralized capital. Not because that was the intention, but because liquidity decides outcomes. And liquidity is not evenly distributed. Large financial actors hold it. Local families usually do not. So succession pressure quietly becomes a consolidation mechanism. A regional machine manufacturer becomes part of a multinational supply chain. A local logistics company becomes a portfolio asset in a private equity fund. The factory might continue operating, but the decision-making center moves somewhere else. And once ownership moves, incentives often move with it. Local firms typically optimize for continuity. External investors optimize for return on capital. Both are rational, but they are not identical. Training programs may shrink. Apprenticeships may decline. Research budgets may tighten. Not because the new owners dislike the company, but because the investment horizon changed. And this is the quiet paradox of forced sales. A policy designed to limit economic concentration can end up accelerating it. Not through ideology, through liquidity constraints. Listen, inheritance taxation does not always redistribute wealth. Sometimes it redistributes ownership. And ownership shapes the future of entire regions. Let's zoom out. Because this isn't some niche issue about a few wealthy dynasties. It's structural. Across Europe, family-owned businesses make up roughly 85 to 90% of all companies. Not a minority. The backbone. They employ around 60% of the private workforce and generate more than half of total private sector value added. Think about that for a second. When we talk about inheritance policy, we're not talking about yachts and aristocrats. We're talking about the ownership structure behind the majority of European jobs. Succession isn't a luxury problem. It's macroeconomic infrastructure. And these firms behave differently. They invest more steadily. They fire less aggressively in downturns. They think in decades, not quarters. Because they're not optimizing for the next earning call. They're optimizing for the next generation. Break succession, and you break that time horizon. Capital behaves differently depending on who owns it. Ownership is not just a legal detail. It shapes the time horizon of decisions. Family owners tend to ask a very specific question. What will this company look like in 20 years. Because the incentives are intergenerational. The firm is not just an asset, it's a legacy. Often the result of decades of accumulated effort. Sometimes several generations of it. Which means the goal isn't simply maximizing this year's profit. The goal is survival, stability, and continuity. Public markets operate differently. Their time horizon is shorter. Not because investors are irrational, but because their incentives are structured around liquidity. Shares can be sold instantly. Performance is measured quarterly. Fund managers are evaluated annually, which means the pressure inside those systems is different. What will this quarter's earnings look like? Will the share price rise next month? How will analysts react to the next report? None of these questions are illegitimate, but they produce different behavior. Maintenance gets postponed. Training programs shrink. Research budgets become easier to cut. Cash extraction becomes more attractive. Not because managers are careless, but because the system rewards short-term performance. Family firms tend to operate under different constraints. Their capital is illiquid. Their reputation is local. Their employees often stay for decades, which creates a different equilibrium. Investments that take 10 or 15 years to pay off are easier to justify. Apprenticeships become part of the business model. Machinery is replaced before it fails, because the owner expects to still be there when the consequences arrive. Empirical research reflects these differences. Studies comparing family-controlled firms with widely held corporations often find higher long-term investment rates and greater stability in employment during downturns. Family owners cut dividends before they cut jobs. Public companies often do the reverse. Again, neither system is morally superior. They simply respond to different incentives. But when succession becomes difficult or expensive, ownership structures shift. Family control weakens. External investors step in. And once ownership changes, the time horizon often changes with it. The firm still exists. The machines still run. The workers still arrive every morning. But the logic of the company has quietly moved from continuity to optimization, from decades to quarters. And over time, that shift matters. Because an economy built on long-term capital formation behaves very differently from one built on short-term capital extraction. One slowly accumulates resilience. The other slowly trades resilience for liquidity. Neither collapse happens overnight. but one builds industrial ecosystems. The other gradually hollows them out. And the difference often begins with something deceptively technical. Who owns the capital? And how long they expect to keep it? Inheritance taxes are often justified with a powerful idea: equality of opportunity. The argument sounds intuitive. If wealth passes from parents to children, the starting lines in life become unequal. Some people inherit assets, others inherit nothing. So the state intervenes, not to punish success, at least in theory, but to prevent privilege from reproducing itself indefinitely. At first place, this logic feels compelling because opportunity matters. A society where success depends entirely on birth is not a dynamic economy. But the policy debate often simplifies something far more complex. Because economies are not races, they are ecosystems. In a race, equality means everyone starts from the same line. In an economy, progress depends on accumulated structures, factories, firms, supply chains, technological knowledge, local networks of suppliers and workers. These structures don't appear spontaneously. They are built over decades, sometimes generations. When a family business passes from one generation to the next, what is transferred is not simply wealth. It is an operating system, relationships with customers, trust with suppliers, technical know-how embedded in employees, knowledge about markets that took decades to acquire. Destroying that continuity does not reset the starting line. It removes part of the infrastructure that allows the race to exist in the first place. And here's where the moral intuition behind inheritance taxation sometimes collides with economic reality. The child of a business owner does not inherit only money. They inherit responsibility, debt obligations, legal liabilities, and the risk of failure. Running a company is not a passive privilege. It is an ongoing job, often a stressful one, often a risky one. Many second-generation owners actually destroy the businesses they inherit because succession is difficult. Markets change. Technologies shift. Competition intensifies. Inheritance is not a guarantee of success. It is simply a transfer of stewardship. And if that stewardship structure collapses, no one else automatically benefits. The factory does not magically reappear as equal opportunity. The supplier networks do not rebuild themselves. The apprenticeships do not recreate themselves somewhere else. Opportunity does not grow in empty spaces. It grows in functioning systems, in firms that train workers, in companies that invest, in industries that accumulate expertise over time. Remove enough of those systems and opportunities shrinks, not because someone inherited wealth, but because the structures that create upward mobility disappeared. Which leads to a paradox. A policy designed to promote opportunity can sometimes weaken the very institutions that generate it. Not intentionally, but structurally. Listen, you don't create equal opportunity by dismantling the ladder. You create it by making sure there are more ladders to climb. And incentives matter more than intentions. When succession becomes expensive or uncertain, families adapt. They reinvest less. They expand less. They sell earlier. They relocate ownership structures. Not because they're greedy, because they're rational. If passing a firm on becomes risky, why build one for 40 years? Taxes on inheritance don't just tax the past, they change the future. They quietly reduce the incentive to accumulate productive capital at all, which means fewer firms decades from now. And here's the uncomfortable part. You don't see that damage because it's a company that never existed. By the way, empirical studies repeatedly show that expectations about the future taxation influence investment behavior long before the tax event itself occurs. There's another number that rarely makes it into political speeches. Demographics. Across Europe, business owners are aging rapidly. Every year, hundreds of thousands of small and medium-sized enterprises changed ownership. Not occasionally, constantly. Roughly 1/3 of European SMEs will face succession within the next decade, which means millions of jobs depend not on innovation policy, but simply on whether ownership transfer works smoothly. Now think about that. If you place heavy liquidity-based taxation on top of this, you are not taxing a rare event. You're taxing a structural transition that happens every single day. It's like installing a toll booth on the only bridge everyone must cross. Some firms make it. Some sell early. Some disappear. And every time one disappears, you don't get a headline. You just get one less employer in a small town. One less apprenticeship. One less future. That's how decline really happens. Quietly. Administratively. One succession at a time. There's one final asymmetry in this debate. Capital can move. but succession cannot. A factory is not just a financial asset. It's a physical structure tied to a place, a workforce, a supplier network, a regional economy. You cannot simply pick it up and relocate it overnight, which means businesses embedded in communities are relatively immobile. But the owners of capital are not. Entrepreneurs can move their legal structures. They can relocate holding companies. They can shift ownership into foundations or trusts. They can restructure the firm long before succession actually occurs. And once those decisions are made, they are difficult to reverse. This is how policy shapes behavior long before the tax event itself. Economists sometimes call this anticipatory adaptation. When future taxation becomes predictable, investors change their strategies in advance. They reorganize, they hedge, they redesign ownership structures years before an inheritance occurs. The public debate usually focuses on the moment of succession. But by that point, the real adjustment has already happened. The company might already belong to a holding structure in another jurisdiction. The voting rights might already sit inside a foundation. Or the business may have been sold years earlier to avoid the uncertainty entirely. None of these decisions appear dramatic. There are no protests, no headlines, no visible crisis, just a quiet shift in incentives. And incentives shape long-term planning. If passing a business to the next generation becomes uncertain or expensive, families adapt. They distribute profits earlier. They invest less aggressively. They sell sooner. They structure ownership internationally. In other words, they shorten their time horizon. Because long-term planning only makes sense if the institutional environment rewards continuity. If it doesn't, rational actors adjust. Not emotionally, strategically. And this creates a subtle but important outcome. The policy aimed to capturing wealth at the moment of inheritance ends up reshaping behavior decades earlier. Investment decisions made today begin to incorporate expected tax structures 30 years into the future, which means inheritance taxation does not only influence succession, it influences accumulation. The willingness to build companies that are meant to survive across generations. And once the mindset weakens, something larger changes. Entrepreneurship becomes shorter. Firms become more temporary. Ownership becomes more financialized. Instead of building businesses meant to last 50 years, investors build assets meant to be sold within 5. That shift rarely appears in political debates, but it changes the texture of an economy. Stable local ownership becomes rarer. Corporate headquarters move farther away. Decision-making becomes centralized, and regions that once had dense networks of medium-sized firms slowly lose them, not through sudden collapse, but through gradual reorganization, one ownership structure at a time. Listen, capital will always adapt to policy. The question is whether the adaptation strengthens the economy or quietly drains its long-term foundations. The worst damage never shows up in GDP. It's invincible. The second factory never built. The extra hires never made. The apprentice never trained. The region that slowly hollowed out. Prosperity isn't just what exists. It's what could have existed. Bad incentives quietly delight futures. Not with a bang, with paperwork. A serious inheritance policy wouldn't moralize wealth. It would distinguish between productive assets and passive wealth, continuity and consumption, investment and extraction. It would protect operating businesses, jobs, long-term capital formation, because destroying capital has never helped those without it. It only reduces the total number of opportunities available. And scarcity isn't justice. It's just scarcity. If you want to understand how succession shapes an economy, look at Italy. Italy is not dominated by giant corporations. It's dominated by families. Roughly 85% of Italian firms are family-controlled, and the overwhelming majority are small and medium-sized enterprises. These companies are the backbone of the famous industrial districts in regions like Lombardy, Veneto, and Emilia-Romagna. Clusters of specialized manufacturers, small firms producing machinery, precision tools, textiles, furniture, or components for global supply chains, often founded after World War II, often still run by the children or grandchildren of the founder. And for decades, this system worked remarkably well. Italian family firms became world leaders in highly specialized export niches, not because they were large, but because they were deeply embedded in local ecosystems of suppliers, skilled workers, and technical knowledge. Ownership was local. Decision-making was local. Time horizons were long. But today, Italian faces a structural transition. A large share of the founding generations is retiring, and succession is becoming increasingly difficult. Studies estimate that over 300,000 Italian firms will face generational succession within the next decade. Not all of them will survive the transition. Some founders have no successors. Some heirs do not want to run the company. And in many cases, the financial and legal complexity of succession accelerates the sale of firms. When that happens, ownership often shifts, sometimes to larger domestic groups, sometimes to international investors, sometimes to private equity funds. The factories remain, but control moves elsewhere. When ownership leaves the local family structure, the logic of the firm often changes. Family firms usually optimize for continuity. External investors optimize for return on capital. Both approaches are rational, but they produce different behavior. Investment horizons short. Employment becomes more flexible. Local suppliers relations weaken. Research and apprenticeship programs sometimes shrink. The company still exists, but the ecosystem around it slowly changes. Italy's economy depends heavily on dense networks of medium-sized firms. This system works because knowledge, skills, and trust accumulate locally. When too many firms change ownership simultaneously, that ecosystem becomes fragile. Supplier networks weaken. Technical expertise disappears. Industrial districts lose coherence. The risk is not immediate collapse. The risk is gradual hollowing out. Not one dramatic event, but thousands of quiet ownership transfers. Listen, economies don't lose their industrial base in a single crisis. They lose it one succession at a time. Inheritance isn't about nostalgia. It isn't about dynasties. It isn't about defending the rich. It's about whether a society values continuity over symbolism. Because when you tax succession until businesses fragment, ownership concentrates, and investment horizons collapse, don't call the outcome fairness. Call it what it is. Economic vandalism with a moral alibi. Next episode: education, skills, and why productivity doesn't grow on good intentions. Politics loves promises. Economics keeps the receipts. I'm Matthias Rieger. Thanks for listening.